Hi, everyone. I'm Frank Malika with KTVU Fox 2 here in the San Francisco Bay Area. My guest is Morgan Stanley financial advisor George Noceti to talk about our economic recovery as we battle through this pandemic. George, good afternoon. Good morning.
Frank, how are you?
Good to have you with us. I guess rule number one, and it's always the case when you're dealing with a market and economy, is don't panic, right? So folks out there that think they're losing everything, this shall pass eventually, right?
Well, don't shoot the messenger. This is a tough time. It's a very tough
Imagine you've
time.
heard that a little bit.
It's a very tough time for everybody. Last year was a great year, and then all of a sudden, in the middle of February, we fell off a cliff. The Dow was down 35%. It's now recovered 50. So that's why you have to keep the faith and hang in there, because when you see that things are oversold, they get overbought later on. And so we're seeing about a 50% recovery right now. Even though we're all at home, we can't go out and buy things. The market is a forward indicator. It looks out into the future. The economy looks backwards, but the stock market looks forward. Right. And it says, okay, things are not as bad. They're not good, but they're not as bad. So we're in a little trading zone right now.
Well, let's talk about COVID-19, the numbers. Sure. Nearly 750,000 cases here in the United States, 40,000 deaths so far. Can the economy recover while this is still out there? Do we need a vaccine to really move forward, or can it move forward hoping for something in the future?
It's a huge barrier for getting our economy going. We're Americans and we want to get out there. And I see people venturing out unsafely. And I think we got to be really cautious. This virus is serious. It kills people. And it has a multiplier effect for infections. And because we put everybody on hold, we've been able to hold it down a little bit. So we will be at risk anytime we go out between now and when a virus is actually, when the serum for the virus is actually found. So it's going to be business not as usual. It's going to be business done differently as we start to get out. We're not going to be at home for a year. That's not going to happen. Right. We're going to start to get out, but in a more strategic way.
Let's talk about the CARE Act. It passed March the 27th, $2 trillion. I know some more money's coming in. But in a matter of 2 weeks, that $350 billion that was earmarked for some of the smaller companies to keep their payroll afloat, to keep those that work for them afloat, and keep them alive, essentially, that money is gone. And there were a lot of people, a lot of businesses that never got to dive in. What's your reaction to that?
Well, when the window opened on a Friday, it immediately closed several days later. It was a new window. People didn't know how to apply for it, except for the more sophisticated businesses that had bank lenders who were assigned to them early on because they did their banking there. Businesses that had advocates, CPAs, attorneys, consultants. Those were the bigger guys. They got all the money. The little guys who are not as sophisticated did not have the resources to do that, so they got shut out. So the government now enacted another act to put in another $300+ billion. And that'll help get out to most of the people. But the money will be delayed. The money will be very, very slow in coming. Right. Because this thing happened quickly. It's not like a slow recession. This recession happened really on one day. And so you have all these businesses lined up together, trying to fill out forms, trying to get information, and our systems are really not set up for that. So money will come, but it'll be delayed. People have to be tenacious, but patient.
Extended unemployment benefits, sick leave has been extended for family members and whatnot. Right. Tell us the downside, because all of a sudden the government's handing out trillions of dollars. I assume they're printing this money. And what does that do to the economy down the road? It's got to cheapen the dollar a little bit.
Well, first of all, there's this unemployment benefit, and I call it unemployment benefits on steroids. Yeah. Because in California, the average paycheck for unemployment was about $480. And with this CARE Act package, I don't call it a stimulus, I call it a bridge. That's really what it is, just bridging people. It locked on another $600. So that means that theoretically, you could get over $1,000 a week, over $4,000 a month in unemployment benefits for up to 4 months, and then that $600 goes away, but the employment benefits are continued out. So in some cases, some employees may not be motivated to come back to work because their compensation might be less than $4,000 a month. And that happens in these small businesses. But you know what? We don't really worry about that. What we really worry about are really people's lives. And you need to be working in order to sustain yourself. So yeah, there's going to be some overspending, underspending. A lot of people are going to get benefits, some aren't. But at the end of the day, the government is really paying for this disaster that happened. The Federal Reserve is funding liquidity in the banks, and Congress is putting money into our pockets for businesses and individuals.
Can you talk about the difference between an event like COVID-19, which took over by storm, as opposed to a kind of a slower, longer push towards a bad economy into a recession? When it happens overnight, what are the consequences?
Okay, this has never really happened before. Even 2008 took months for this to roll
Right.
out.
We knew it was coming.
Yeah, the Great Depression took years for it to roll out,
Mm-hmm.
and the recoveries were much, much longer. This is unique. This was sudden. On day one, we had to stay home. You don't see, you drive your car down the street, you see the grocery stores open, and that's it. This town is closed. So when that happens, it's a very, very sharp and deep downturn. And that means that recovery will be quicker. While we're in it, it's very slow. But we would expect the recovery to start occurring probably in the following month. You won't really see it, but we'll start to see the numbers. We'll start to see a very, very slow, gradual recovery.
How come the markets bounce back so quickly? I know it's not 100% back, but if you were to go cash out, 2 weeks into this, you would have suffered a lot of loss. It's bounced back 50%, but yet we still have the problem.
Exactly. If you would have cashed out in the middle of February when the Dow was down, 35%, you would have baked in a huge loss. You would never recover from that. But if you stayed in, you gained about 50% of it back. So the market, all of us really look at what's happening today, how things are affecting us today. The market doesn't do that. That's already happened. The market is forward-looking. It's not always right, but it looks out into the future. And it says we're going to get more testing in. The government is going to pay our way out of this recession. We're going to find a vaccine for this. Mm-hmm. This is going to happen over a period of time. So it's going to take a lot of time for the market to get back to, where it was prior to February 19th. If we look at, Frank, if we look at the GDP reports, which will come out for the first quarter, we're going to show GDP down for the first quarter about 3%. That's our gross domestic product. That's the report card for the economy. Okay, not great. It was negative. Then we're going to have a second quarter, which we're in right now, and we expect that. And we're the big bear. Morgan Stanley is the bear of all the economists. We think that the second quarter is going to be down 38%. Wow. That's 2 negative quarters. That's technically a recession, even though we know we're in one right now. But down 38%, it's very, very significant. Now, to the contrary, because it's very deep, in the third quarter, we would expect the recovery up about 28%, which is a huge GDP number. And that's because there's pent-up demand for spending. But we don't think the recovery is going to be a V-shaped recovery. It's going to be more like a U. We went down hard, and the U part, the bottom part, is the recovery part. So it starts to happen in the third quarter, in the fourth quarter. We really don't see it really kicking in a big way until the vaccine is found and people get tested. It's not going to be an absolute thing. There still will be people with the virus, but it'll eliminate people from actually contracting it. And then we're going to see 2021 as the time where we start to get back to where we were.
How about China? They're a little ahead of the curve right now, starting to let people out and about. Can we use them? Is their market recovering right now?
Yeah, actually, China, arguably now, because we don't have the data.
Yeah, we don't know everything.
Yeah, arguably. But actually, they recovered pretty quickly. They were late to the game also in admitting that there was a virus. When they did, they went to a total lockdown. Now, that's a communist country. So they can do whatever they want with the town, city, or the country. It's more absolute. Nobody went anywhere, did anything. And so because of that, their plateau of the coronavirus really leveled out, plateaued, whereas ours and the rest of the world was actually going up. So they have been getting people back to work. In fact, Apple Computer is closed down in the United States. It's open in China.
It's open for business there.
McDonald's, you can go in for takeout. But in China, it's wide open. So that doesn't mean they found a cure. That means that they were able to contain it. And they're going to have little spikes here and there until we get really serum for the virus.
Unemployment's got to concern a lot of people out there. 22 million. We should hit probably about 20% by the end of the month. A lot of those people may not go back to jobs And if they do go back to jobs, they could be completely different because of our new normal, so to speak. That must be alarming as we sit.
Right. So it's all about how does it affect me as an individual supporting myself and my family. That's kind of the main problem right now. So it will be different. It's not going to be the same. We're going to go places, travel places, and do things differently. It doesn't mean that we're not going to be on an airplane. It doesn't mean that possibly we're not going to be on a cruise. It doesn't mean that. It just means it's going to take a long time for that to happen. And our jobs will actually change in how we're conducting them. Safety is the ultimate number one thing,
Right.
more important than money. It's the safety of you and your family, because this thing is deadly, and it's transmitted without, it's invisible. So we have to be extremely cautious for that, or this will reoccur again. This will spike up. So we have to be very, very judicious, very cautious. And I know California and New York are really serious about this. The middle of the country hasn't been affected as much, but if they don't practice the same safe practices, it will spike up there until there's a vaccine for this.
Looking at the economy a little bit, retail stores were kind of bleeding anyways prior to this because of Amazon and a lot of the online companies now. And now this is going to hurt even more. Commercial real estate, retail, all that. I know you don't have a crystal ball, but this will not bode well for stores. I would think not, like shopping malls, that kind of thing.
Right. Prior to the recession, retail was suffering because it was overbuilt. For the population we just have too many stores.
Mm-hmm.
And so everything gets diluted because of that. So there is going to be a transition from the great malls to more individual places. The internet sales have been increasing substantially, about 15% every year. So this transition was happening. And now you have the recession that we're in, and nobody's able to shop. There will be store closures, and there will be consolidation going forward.
Imagine you've gotten a few phone calls the last month or so. Huh?
Right. This is the most intense time I've ever been in. In 2008, when banking failed, we were on the phone with clients. We got them calm. This is different. It's because you're home and I'm home, and all we have to do is look at the bad news that we hear on the major networks, and about the economy, and we look at our portfolios daily. That didn't happen before because only sectors of the economy were out of work. Everybody stopped working. So that's so people worry. And that's just a normal thing to do. So our job as financial advisors is to calm the storm, be transparent, put things in perspective, communicate, hold Zoom meetings, webinar meetings, have constant contact, send out emails, communicate more than we ever should. A lot of advisors go very dark when there's bad news to report. And I think you should do exactly the opposite. You're managing clients' money. It's important to them. You owe them that to give them the tough news and to talk about what the plan forward is.
You've become more of a chaplain now.
Well, exactly. Yeah.
All going to be good.
A good listener. Yeah.
Well, I know you got some tried and true rules. You've gone over a little bit throughout the interview, but on number one, I guess, is don't cash out and weather the storm, right?
Yeah, I mean, that's really the biggest mistake. And I know that in 2008, some people did that. And historically, they've never recovered from that. There was a couple maybe that got lucky, but you can't market time. It's mathematically impossible to do that. So this is a good teaching moment for all of us. This recession teaches us that, yes, I should have had more money in reserve, some cash. I should have been better diversified. I shouldn't put all my eggs in the United States basket. I should really look at, growth companies and value companies and small companies and mid-sized companies. And I should also be looking internationally and not have 100% of my money in the market, but have some in fixed income. Because our clients, basically, because we're diversified, their portfolios are down half of what the market has really been showing. And that's because of diversification. But that takes time, and you have to do it before an event happens. And you have to make sure you're organized in order to do that.
Right. And I think most importantly, and you've touched on this, but historically, the market recovers. It's kind of cyclical, isn't it? We have good years and bad years, but the good outweighs the bad.
I mean, you can never guarantee anything, but historically, that's an absolute. The market comes back. I mean, if you're invested in the S&P 500 the past 15 years, you've done about 9%. But if you got out and missed the 10 best days, you only would be up about 4%. Mm-hmm. So staying invested. Now, the problem is if you're getting ready for retirement, and all of a sudden your portfolio is down 10 or 15% and you're taking money out.
Right.
So those people suffer more, but those that are in the workforce and continue to be in the workforce for a long time, you weather these ups and downs of the market. In fact, if you're still working and you have a 401k plan, there are some people that feel, oh, I shouldn't invest because
add more.
Yeah, because you're buying low. This is what you're supposed to do. Sell high and buy low, but we don't do it. We do the opposite. So if it's got a 401k plan, you really need to maximize that.
Yeah. How about in '08? How quickly did we recover coming out of the mortgage problems?
Well, to be quite frank, to be quite honest about it, Frank, we are still recovering now.
Yeah.
I mean, but if you look at the V-shaped recovery, what happened was in 2008, the market was down. You take the S&P 500, at the end, it was down 37%. In the middle of 2008, it was down 45%. So it was down 37%. And then if a client was diversified and being actively managed, within 12 months, they were back to where they were. Now, if they weren't quite managed properly, it may have taken them a couple of years. But those individuals that were just invested in the hot companies in one sectors, it's taken them even much longer to recover. Banking is just recovering now, actually, And so we have these two bookends, 2008 and 2020. And in the middle, we had a bull market where people were doing pretty well, but you had these two terrible bookends. And that's kind of what investing is about. You take on risk.
Should we be worried about our homes and the values dropping? Because a lot of people use that as kind of their ATM to do projects, to get their kids through school, especially here in the Bay Area where it's inflated. I would imagine home values may drop a little bit, right?
Well, that's a good point. In 2008, when a lot of people lost value because they weren't managed properly, what they did have is their homes. They had the equity in their homes that was coming back. So a lot of baby boomers have really not moved because that's where a lot of their wealth is. So fast forward to today, we're in transition right now. There could be some banking issues. If you've lost your job, it's going to be hard to make payment on your house. You could have a credit report ding, also for not being able to do that. The value of your house can go down simply because buyers don't want to commit to anything long-term. Even though our Bay Area is very, very popular, this is not helping the value of homes. So we could see a decline, which then again provides an opportunity for some people who are waiting for values to come down to get in and buy something. Well, so it's a very complicated area, especially for those who have HELOCs and other things like that attached to their houses.
Well, I don't want to leave on a down note, but I think the most important thing we can take from all of this is we're going to get through it and be better.
We're going to economically get through this, Frank, and people are going to be okay at the end of the day. But what we have to do, it's a full court press on the beginning of this problem. That's the virus.
Yeah. Once we can get that figured out, a lot of this stuff will fall into place.
Exactly.
All right, George Noceti from Morgan Stanley. Always a pleasure, George. Great insight as usual, and want to thank you for joining us here on Fox.
Frank, always good to be with you. Thank you.
All right. Thank you, George. I'm Frank Malik out here in the San Francisco Bay Area. We'll send it back to you.